Yeah, sure. Thanks, Dan. So just focusing in on this section here, essentially there's two areas of the market. One is general reps and warranties insurance, which is to cover sort of unknown risks. And the other is contingent liability insurance, which is to cover known risks. So contingent liability insurance, typically the premiums are 3 to 8% of the insurance limit, and they are to cover riskier issues. It might be a matter that's been identified during due diligence. It may be a transaction structure which is being utilized, which could come under scrutiny from the tax authorities. The contingent risk covers specified known risks in the transaction. Reps and warranties insurance is the more general cover, and this covers the broad range of risks arising from the acquisition agreement. And why do people use insurance? We'll get onto that in due course, but essentially they help to facilitate a deal and to allow people to do a deal in a different way. The premium rates for general reps and warranties insurance are lower than specific risk, and for US transactions you're talking 1.5 to 3% of the insurance limit, and we'll come in due course to the other parameters.
And Richard, are you seeing most of the activity on the rep and warranty side or on the contingent risk side?
The majority of policies are reps and warranties insurance, because that's just the nature of it. Although, that said, there is a heavy volume of premium in the market by virtue of the higher rates online for the contingent products.
Excellent. Thank you. Now, interest in these products, it can come from both the buy side and the sell side. And can you walk us through sort of the buy and sell side transactions?
Yeah, absolutely. So just focusing in on here. So as you said, there's two types of policy. There's a seller policy and a buyer policy. So focusing on the seller policy, this was the original type of insurance that is a third-party insurance policy. And just walking through the process, the trigger is always a breach of the rep or warranty provided by the seller to the buyer in the acquisition agreement. With the seller policy, if there's a breach of warranty, the buyer is entitled to claim damages from the seller, and that's what they do. The buyer then pursues the seller for breach of contract, and the seller policy pays for the defense and settlement of that claim. As you can see from the scenario there needs to be an underlying claim in order for the insurance to kick in. Now, the buyer policy is a first-party insurance. So although the trigger is still a breach of the rep or warranty provided by the seller, in this case there's a direct contract between the buyer and the insurer, and they turn straight to the insurer and can claim for the financial loss that they've suffered. And the advantage to the buyer policy is clearly there's no need to involve the seller in any claim, and the insurer will waive all subrogation rights. So it's a much more effective policy, and as a result accounts for 75% of the policies now sold in the London market. Even